Are you thinking of ways to tap into your home equity so that way you can either start creating a nest egg, or maybe you found an investment and you want to put this money to use? Well, in this video, I'm going to talk about a home equity loan. Unlike a home equity line of credit, this is something that's completely different. So I'm going to explain some pros and cons and essentially what it is. And then you can decide for yourself what's the best way to go about moving forward and tapping into some of that home equity. My name's Seanu Uyehara. I'm an area manager with Geneva Financial, helping you get your mortgage right all across the country. Whether you're a first-time home buyer or a seasoned investor, I've created this channel to help you understand the ins and outs, and that way you know what's the right mortgage for you. So if you ever have any questions, you can reach me via email. You can shoot me with any scenarios that you have. If you're ready to get pre-approved, we can certainly help you with your home financing or your refinances as well. Now, so many people have been calling lately and they're wanting to tap into their home equity, but the problem is they don't want to refinance. And I don't blame them, because you have a really low interest rate. So many of you are sitting at the 2, 3, 4% range. And to do a refinance today is going to be really expensive, because you're probably going to be somewhere in the 6s, maybe even the 7% range. So how do you get that equity out with the most cost-effective way, and you don't have to pay an arm and a leg? Well, here's a great program that you can take a look at. It's called a home equity loan. We did a video like this a while back, and I actually had the two confused. Someone pointed it out to me, which was very good on your part that you actually caught that, because I didn't even catch it, and I don't even think my team caught it. So if you're watching this video, we're going to get it right this time, and this is a home equity loan. Now, so many banks out there do HELOCs, or a home equity line of credit. Now, the home equity line of credit has a lot more flexibility, because it's essentially like a credit card on your house. Let's say I owe $100,000 on my house, and my house is worth, call it $300,000. If I wanted to take out a HELOC of $100,000, I could certainly do that. And the great thing is I can charge it like a credit card, pay it down, charge it, pay it down as many times as I want. And typically on a HELOC, they give you up until about 10 years to draw on your funds. And at that 10-year mark, they stop you from drawing on your HELOC, and you have to start paying the loan back over the next probably 20 or so years. Now on a HE loan, you get one lump sum when you complete your transaction. So again, in my scenario, let's say I owe $100,000 on my house. It's worth $300,000, and I want to take out $100,000. So at the closing, I would get a check for $100,000, and now I have fixed payments that I need to make on that loan. So the advantage to that is I don't have any fluctuations in the interest rate and the market, which so many of you, if you have HELOCs, we've all seen our interest rates go up over the last year. I can tell you my interest rate probably started at maybe 2, 3% at the time. Now I think the last time I checked my statement, I'm probably somewhere in the 8s. So the minimum payment on my HELOC has definitely gone up. However, on a HE loan, you know what your payments are going to be. It's a fixed payment, so you know exactly what it is, and you pay it back depending on the terms. Terms could be anywhere 5, maybe even 20 years long for you to pay that money back. But the downside is you only get to use the money once. Depending on what you're trying to use your equity for and what your long-term strategy is will determine which way you want to go. Not many banks offer HE loans. I've never heard of it until actually my credit union offered it several years ago when I first signed up with them to take out a HELOC. So it's something, again, some people might just gloss over it. They may not know what it is. They may look at you like you have a third eye, because it's not something that's talked about too often. But typically I have seen HE loans through smaller community banks or credit unions. So if that's something you're looking for, I would definitely start there first before you start shopping around, or maybe a few banks tell you that they don't offer that product and then you get discouraged. Tapping into your home equity can be a smart thing to do if you do the right thing with the money. A lot of people got into trouble back in the day when they used their house like an ATM. So first and foremost, I would strongly caution you to really understand what you're going to do with that equity. I've had some of you that watch my channel reach out to me about taking out second mortgages on your house to renovate your kitchen. And I told you, I don't think that's a smart idea. You know, with the way the economy was going, and even at this time, I still don't think that's a good idea to take on more debt for the fact of making your house look nicer. Yes, there's always value in that. And there's utility when you come home and you feel good and you see your kitchen the way you've always wanted it to look. But if it's going to add another $500, $600, $700 a month to your payment, and you're not sure if maybe your job or your company or maybe your industry is doing well, I personally would not be able to sleep at night. So you got to really dial that in as far as if you're taking out money out of your house, what are you using it for? And what's the repayment going to look like? And again, on a HELOAN, it's a fixed payment every month. So taking out X amount of dollars, depending on how long you plan to pay it back, what if it is $500, $600, $700 a month that now you're adding to your monthly obligations, which makes things that much tighter. So if you don't have savings, if your job's not stable, these are all the things like I would challenge you to ask yourself these questions before you go forward and take the money out. Now, the flip side is if you're putting money into an investment or into a cash producing asset, I like that, because if the income that can come out of the investment can outweigh the payment, I would do that all day long. But remember, you have to run your numbers and do it on a worst case basis, because if you can still make money off the worst case scenario, then do the deal. But if you need all the stars aligned, the property has to be rented out, I need to get X amount of dollars every single month, my vacancy rate has to be this in order for this to work, and only to work, are you stretching yourself too thin just to do an investment? So these are the kind of things where, again, things can take a turn for the worse. We don't know how much longer this is going to take for us to get out of this rut that we're in as an economy right now. So sometimes you do play it safe. Sometimes, you know what, you will take a gamble. But with the HELOAN, you do have the ability to get into your home equity. You don't have to do a refinance on your house. It's usually a pretty cost efficient and a pretty expeditious process. Probably just need to pay for an appraisal. And as long as you can qualify for the loan, I wouldn't see why you shouldn't be able to get your money out in a couple of weeks. But just remember, when you take out a second mortgage, you are adding more debt. There's more that's being owed to your house. So in my scenario, if I owe 100 and I take out 100,000, I now owe $200,000 on a $300,000 house. The house might be worth $300,000 today, but in some parts of the country, we're seeing values recede. So what if the house goes from 300 to 275, maybe to 265? There's not as much equity there. And if you're constantly thinking that, hey, maybe we're going to do this investment and we're going to have all this money, I can sell the house and we can still walk away with a ton of money, that could very well not happen because of where the market is right now. So remember, think a few years out. Don't just make your decision based on today, what you're wanting to do. Think about some worst case scenarios that if the market pulled back maybe another 10% in your market, could you still sell your house if things got really bad? Or are you pushing yourself and things are too thin and maybe you don't have enough equity, or maybe you don't have enough of a nest egg or emergency savings on the side to carry you through in case you lose your job or anything else happens? There's always lots to consider when you're looking at doing a refinance, a HELOAN, a HELOC. You have to ask yourself more of these questions versus who's got the lowest interest rate. Many banks and credit unions are going to offer pretty competitive rates when it comes to these products, simply because mortgage rates are up and banks out there know that people want to access their money. So for them to gain you as a customer, they're going to do something to try to get you into the door, but make sure you understand the ins and outs of what you're signing, as always, because you don't want to put yourself in a bad spot when it comes to these types of mortgages. So if you ever have any questions, you need a second opinion, again, that's what my team and I are here for. Send me an email. We'd be happy to point you in the right direction so you can win in real estate. Thanks for watching, and I'll see you on the next one.